Folks, Dan Frio here. The rate update today is January 6th, 2021. Jobs reports come out yesterday. I apologize I didn't post an update last night. The market tanked. MBSs were down, I think, about 40. I'm going to recap all that now. But there was conflicting data with the jobs report. But the big news out yesterday was the Federal Reserve minutes came out and they said what they're going to do. So find out more about that and where rates are going this morning right after this. Okay, so yesterday we saw the jobs number come in and it blew out the numbers, okay? But today we have the unemployment claims that just came out that kind of conflict with the data that we got yesterday. But the biggest move that we saw yesterday and so far today that you'll see is from the Federal Reserve coming out saying that they're not only going to taper and they're going to do it pretty hard and fast, but they're going to start to sell off their MBSs. I'm going to go over that and a bunch of other things right after this CNBC update.
Looking at U.S. jobless claims rose to 207,000, it looks like, Andrew, as this thing scrolls across my screen. 4-week average rising to 204. That's a little bit more than the expectation of 195 and up from, I don't know if they revised last week. Yeah, they revised last week up to 200, so a modest increase there. And then I'm looking for the trade deficit. I think it's not a big deal because we get the advance on that. It's supposed to be in around $81.5 billion, a big surge that came from got tighter in October, and then it widened again, we think, in November. The expectation is that as bottlenecks ease off, we might get better results on trade next year that's this year, as some of the bottlenecks, we get the exports going out of the country. Just real quick, I was reading a forecast for tomorrow from Pantheon, our friend Ian Shepperson over there. He says some of the high-frequency data suggests it could be as high as 1 million tomorrow because of the rebound from November that we were talking about last time, with a major question mark as to whether or not Omicron ends up infecting the data somewhat, Andrew.
Hey, Steve, so that's the Steve Leisman analysis. What is the Jay Powell analysis, if you were to try to read his mind right now?
Of which part? The jobs or the jobs or the jobless claims numbers? Which part are you interested in?
I was going to go with the jobless claims numbers, but you intrigued me by what Pantheon's saying. So, you can do both.
Yeah. I mean, I think that Powell counts among his blessings that he's got these problems with inflation and the need to take away stimulus, but he has a pretty good economy. Unemployment's down near 4%. I don't think there's a question that it's going to go. It's going back up now. You have this, I don't know what you want to call it, blip, hopefully, when it comes to Omicron. Some people are going to be quarantining, staying home. You might have a blip in January, but you should get a rebound in February. I think, and the concern here is that you don't necessarily see it yet, but that this year you start to get wage inflation come into the inflation numbers. You haven't seen it yet necessarily, but if wages keep going up the way they've been going up, you could start to get an issue of wage inflation. So that's got to be a concern, as well as a benefit that he has, that the job market's in pretty good shape for the Fed to remove stimulus.
Okay, Steve, stick around. We want to get over to Mike. Want to get your take on these numbers and what you think the equity market and the traders are going to think about all of this.
Yeah, modest tick up in claims relative to forecasts, and from last week we get it back above 200,000. I think it still tells you that the job market is behaving relatively tight. We get a huge payroll number tomorrow that's going to underscore that. The JOLTS data this week, a lot of people leaving their jobs, all feed in that direction. The big question is, to what degree we do have a little bit of a stutter step in growth because of Omicron this month, next month. I think investors in general expect something like that, but they're really intent on looking right through it. If you look at the way the markets are repricing here, it's mostly about, wow, this thing's spring-loaded to take off once we get through perhaps a brief wave. So that's where also the surprise could be if we do see a more pronounced slowdown. So far, not a big change to me, the basic premise of where investors are coming from right here. Mike, this morning, I was just going to quickly say, it's mostly about positioning. It's mostly about, did I own too much Microsoft and Salesforce coming into this year? here, and I'm already underwater 4 days in.
Okay, so what I want you to take away from that is kind of at the end of that clip, and I'm sorry it was a lengthy clip, was they were saying that everybody expects when the Omicron wave goes through. If you didn't catch this, rewind this. Everybody is expecting the economy to rebound really well. Okay, so let's recap all this stuff that's going on. Just in a macro right now here's what we're looking at. Jobs are coming back. Okay, the unemployment rate's down and it's getting even lower. People have money in the bank. Okay, you might believe that or not. Everything's starting to calm down. Okay, from the Omicron. The disconnect right now is the jobs. Okay, so that's what we're really following. But the Fed is saying, hey, the economy looks good on our end, minus the Omicron, and it's not as devastating as Corona was. Okay, so what they're expecting is within the next 3, 4, 5 months, we have a huge rebound. Okay, so what happens when all this happens is companies do very well. So people start putting more money in the stock market as an investment. They deplete their buying of bonds. Okay, so what we always discuss here is the supply and demand of the bond market, especially MBSs. MBSs is our mortgage-backed securities that trade on Wall Street. They're the biggest component of the mortgage rate. Okay, so supply demand. Just think of it this way: you have a supply demand chart. The more demand you have for an item, okay, pushes the price up. And when we push a price of a bond, especially mortgage bonds, up, the yield or the mortgage rates come down. Okay, so here's what's happening. The Federal Reserve just stepped in and said, we're not going to buy $40 billion of mortgage-backed securities anymore. Okay, so that's already depleted the demand. They're going to cut that and they're going to deplete it probably within the next 4, 5, 6 months. Okay, and they're going to stop buying. But the big thing they said yesterday is, when are they going to start unwinding? What they mean by unwinding is starting to sell their holdings of mortgage-backed securities back into the market. So now we have less demand and more supply of mortgage-backed securities. That's going to drive down the prices and drive them down and down and down, and yields up to the point where an investor is like, okay, I'll buy. What rate that is, we don't know the appetites. So that's what we closely follow here on this channel. So let's dig in on what news is coming out today and how it's affecting the markets. So here's what we just went over with you in regards to that video. And I apologize. I know it was about 3 or 4 minutes long. I don't mean to take up your time with that, but I think I'm trying to educate you guys on what's going on behind the scenes and why, when this happens, that happens as a consequence. Okay, so it says Federal Reserve puts wheels in motion for balance sheet reduction. So they're going to start reducing stuff, especially mortgage-backed securities, off of their balance sheets and putting them back into the market for people to buy. All right, that's that part. Then you also see stock market news live. Stocks drop, tech sink after Fed hints that early liftoff on interest rates. Okay, so they're not only saying they're going to stop tapering, they're going to start selling mortgage-backed securities, and they're also going to start raising the federal funds rate. It's a triple whammy. My concern is they're doing too much too fast, and it's going to shock the market. But only time will tell, and I can't control what they do. The next thing is the economic calendar for today. You're going to see over here, ADP payroll numbers blew out the numbers, double what was expected. Okay. The odd thing is we go to today, the initial unemployment claims, they're up. Okay, not a lot, but they're up. So we have a huge number of people going back to work and a lot of people quitting work and continuing to claim on unemployment benefits. Sorry about my stutter. So there's a disconnect here. Where's everybody coming from? The numbers kind of don't jive. Okay, so that's that part of it. I'm going to dig deep into that for you guys. What's this doing for the MBS market right now? Well, yesterday we had a complete drop down. Let's go to the 1 month chart. Let's go to the 2J chart. I'm sorry. Let's go to the 1 month chart. Look at this. Okay, this is what happened over the last few days. Okay, but so far today we're down 23 ticks. Yesterday we ended down about 40 ticks. So we're about over 100 basis points off from where we started the week. That's a big move, guys. What I want you to understand though is this doesn't correlate. Here, let's break down this area right here, the 30-year UMBS 2.5. Okay, just look at this. This is MBS's, mortgage-backed security. It's a bond that trades on Wall Street. Okay. When this is the number of what's happening to the price of that bond. Again, when the price goes down, yields go up. This does not equate out to mortgage rates going up 0.23%. There's not a complete correlation saying if this is down 23, interest rates are going to go up X. There's not a direct correlation there. So what I'm trying to show you though is it is moving down. All right, a lot of people say, no, the Fed's not going to let rates go up or whatever. Guys, it's in the last 3 months, we went from a 103 to a 101. That's 200 basis points. Yes, rates are going up. Okay, that's why I want to emphasize there. Now, where are rates right now? I don't have, this can't be right because yesterday's rates or MBSs were down 47, so there's no way rates went down. But we're going to go with this because this is Mortgage News Daily's analysis of the market. So they surveyed lenders all over the country to figure out where are rates. All right, so here's what the average rates are throughout the country. We have the 30-year fixed at 3.34. It's down 1 basis point, meaning it's down 0.01. We have the 15-year at 2.69, down 0.1 or 0.01. I'm sorry. The FHA/VA is at 2.98. 30-year jumbos at 3.22, and the 5-year ARM is at 3.79. It's still about just shy of 0.5% higher than 30-year fixed. So if you're in an ARM, get out before rates move any higher. Lock in that fixed rate. Okay, so that's where rates are right now. If we could be of any help, okay, so let me explain this to you. If you're looking for a house, if you're looking to get pre-approved, love to help you. If you're building a house and you're just like, hey, my options with my builder aren't very good, let us know. If you're in a forbearance, there was just a ruling out. We got 20 state federal attorneys going after FHA lenders because they're not giving people options in the forbearance process on how to get out of it. That's what I've been warning you guys. Okay, the lenders aren't going to want, they want to force your hand at doing something. They don't want to sit in the background and just say, I will take payments when you can make them. So if you're in a forbearance, please reach out and let us know. If you're in the mortgage process right now, okay, the mortgage rates have run big in the last 3-4 days. All right, so if you're with another lender and they started the process, but they don't have you locked in yet, please email us that loan estimate that they sent you. Within 3 business days of pulling your credit, the lender has to send you what's called a loan estimate. We reference that as an LE, just acronym. So we ask you to email us your loan estimates. Let us review it. We are now the largest brokerage in the country. We're going to scan your details to over 137 lenders right now to ensure you guys, we're shopping it for you. We're shopping it over 137 lenders. You can't do that on your own. And even if you go to some of these sites where you get 3 quotes, why not get 130? So we're going to scan the whole market and say, here's the best program out there for you. Okay, that's what we do. All right, so I need you to email those loan estimates to lereview@therateupdate.com. And also, if you're in the process and you just need our help, we love talking to you because your situation is unique to you. Okay, so how do you reach out to us? Well, there's several ways. First, you can give us a call, 844-775-5626, or schedule a meeting. Or if you're like, hey, Dan, I trust what you're doing. I know you can get me the best things on your reviews. I talked to somebody yesterday and they said they scanned everywhere to find some bad news on me and they couldn't. So I didn't even realize that. So kudos to me, I guess, on that one. So that's it for right now. We'd love to hear from you. We'd love to help you. So I'll be back today. There are some changes in the mortgage processing and so forth I want you guys to be aware of, because if you have a second home, rates and costs for that are going to go up dramatically here shortly. It starts in April, where all the main companies, or the FHFA, I won't go over that, but they're coming in and saying we're going to charge 4 points if you're looking to refinance a second home at 80% or higher. So I'm going to go over some details later today to let you guys know what's coming down the pike. So that's it for right now. please, if you would, if you find value in this channel, don't forget to give me a thumbs up, subscribe down below, and hit the bell every time I post a video. You get an alert. I'll see you later this afternoon, guys. Take care.